Welcome back to the Deep Dive. Today we are jumping into one of the most volatile, yet I think structurally critical elements for the future of global energy, uranium. It's no longer just some abstract commodity or, a relic of the Cold War.
Not at all.
It is absolutely central now to the dual pressures of global decarbonization and maybe even more urgently, energy security.
Yeah.
And you, our listener, specifically asked for a breakdown of this impending nuclear renaissance, and critically, how someone in the Indian retail market, where there are basically zero pure domestic products, can actually participate.
And that's a perfect way to frame it. I mean, we've synthesized the sources, and the conclusion is pretty much unanimous. Uranium is positioned not for a temporary spike, but for a structurally higher demand over the next 1 to 2 decades.
So not just cyclical noise.
No, this is a profound market correction. It's being driven by climate commitments and, frankly, geopolitical reality.
Okay, let's unpack this then. Our mission today is laser-focused. First, we need to understand the drivers behind this massive projected demand growth.
Right.
Then we'll analyze why the supply side is so inelastic. This is really the crux of the bull thesis and what that means for prices.
And then the practical part.
And finally, the practical part. We will break down the actual overseas investment routes available to you, detailing the products and the specialized risks you have to manage.
Let's do it.
So let's start with the big why. Why is nuclear suddenly back in the good graces of policymakers, considering all the political and environmental baggage it's carried for decades?
It really just comes down to physics and reliability. I mean, solar and wind are crucial, we all know that, but they're intermittent.
Right, the wind doesn't always blow.
Exactly. The world needs reliable 247 baseload power that is also carbon-free to meet those net zero goals. And nuclear is, well, it's the only mature technology that fits that gap at scale.
And the energy security angle must be huge now.
Oh, it's massive. The urgency for energy security, especially after what we saw with the European gas crises, has made countries really prioritize domestic stable power. And nuclear provides just that.
And we can actually quantify this resurgence. The World Nuclear Association, the WNA, they're painting a picture of, staggering growth, not just incremental changes.
They absolutely are. Their projections show that uranium demand just for reactors will rise approximately 28% by 2030.
Just by 2030.
Just by 2030, reaching about 87,000 tons a year. That's a huge move in the short term, and it really confirms this renaissance is already happening.
But I've seen the longer-term numbers, and those barely scratch the surface, right? The 2040 view is where it gets really crazy.
That's where the structural story really takes hold, yeah. Demand is projected to more than double by 2040.
More than double.
Hitting 150,000 tons annually. And to absorb that, nuclear generating capacity, which is just under 400 gigawatts right now, is forecast to grow to 746 gigawatts.
So almost a doubling of installed global capacity.
Almost a complete doubling.
But, nuclear politics are famously volatile. How confident are the sources that this isn't just wishful thinking? Is the momentum actually real this time?
It feels real because it's being driven by the two most populated, most energy-hungry nations on Earth. We are seeing major restarts in places like Japan, which is a big deal.
Sure.
But the sources all point to the relentless, aggressive build-outs in China and India. That's the core of the forecast growth. China is effectively building a new reactor every few months.
And this doesn't even factor in the technological shift, does it? The small modular reactors, SMRs, people have been talking about them forever, but their deployment seems to be just around the corner.
It changes everything. SMRs are smaller, they're faster to deploy, and because they're inherently safer, they face a much less arduous regulatory path.
So you don't need these gigawatt-scale behemoths of the past.
Exactly. And as SMRs start rolling out commercially over the next few years, they just add another layer of future demand that all the big players, the utilities, are now forced to factor in.
Here's where it gets really interesting. So if demand is set to double, what does the supply side of this equation look like? Because in mining, supply almost never reacts quickly.
That inability to react quickly, that is precisely why this is a structural long-term story and not just some speculative bubble. This is the structural supply deficit.
Okay.
The sources, from the WNA to analysts at banks like UBS, they're all warning that output from today's operating mines could realistically halve between 2030 and 2040.
Wait, halve? So you're saying existing production could be cut in half at the exact same time demand is set
Yeah.
to double. That equation doesn't work.
It's an impossible equation. It guarantees a deficit unless something drastic happens.
Right. And what's fascinating here is why the market can't just, flick a switch and open new mines.
Well, bringing a major new uranium mine online is a capital-intensive, multi-decade process. You're looking at a 10 to 15-year lead time, often longer.
Because of all the red tape.
It's a regulatory labyrinth. Environmental permitting, community consultations, getting licenses for radioactive material handling, and on top of that, securing political stability. And for years, when uranium prices were in the dumps, nobody invested in this painful process.
So we've got a decade of underinvestment colliding head-on with a decade of policy-driven demand.
Yep.
That explains the bullish price outlook.
It does. I mean, let's look at a snapshot. As of early 2026, the spot price is sitting around $80 a pound. It's up about 9% over the past year.
And analysts see it going higher.
Many are increasingly confident in seeing prices stay elevated or even exceed $100 if these deficits really materialize.
But the real signal isn't the spot price, is it? It's how the big, sophisticated buyers, the utilities, are behaving.
That is the key signal. Utilities are typically very conservative. They're long-term buyers, and right now they are actively signing long-term contracts at elevated prices, roughly $75 to $85 a pound.
So they don't expect prices to come down anytime soon.
They have zero expectation that this supply tightness will ease. When the end consumers lock in supply at these high levels, it tells the market that sustained strength, not just a short-term spike, is the base case.
And this all leads to that major consensus forecast you see in the sources, the expectation of a likely decade-long bull cycle for uranium.
And that whole forecast rests heavily on the concentration of supply. I mean, you need the 3–5% annual demand growth, sure, but the whole tightness narrative hinges on supply staying highly concentrated in the hands of just a few key players.
You're talking about Kazatomprom and Cameco.
Primarily, the state-owned giant Kazatomprom in Kazakhstan and the publicly traded Cameco in Canada. That concentration is also a massive source of geopolitical risk, which, kind of ironically, feeds back into the bullish price scenario.
Which brings us to the crucial practical section for our listener. How do I, sitting here in India, actually access this global theme, given that there is absolutely no pure uranium ETF or anything like it listed on Indian exchanges?
That lack of an onshore product really dictates the route. Your access has to be gained through overseas markets, and that means using one of the channels established by the RBI.
So the Liberalized Remittance Scheme, LRS, or the Gift IFSC route.
That's right. For most individuals, you're looking at LRS, which allows you to remit money abroad up to a certain limit each year for investments. The Gift City route is another option, but either way, the point is you have to transfer funds overseas first.
Okay, so assuming you've got the channel set up, let's detail Avenue 1. This is generally the most diversified and, I guess, lowest risk approach. Global uranium ETFs.
Right. These are the preferred entry point for most people. The two big ones, the dominant players, are the Global X Uranium ETF, which trades under the ticker URA, and the Sprott Uranium Miners ETF, which is URNM.
And what's the key difference between the two?
Well, URA is a bit broader. It holds a mix of the pure producers, the developers, and sometimes related nuclear companies, infrastructure, components, that kind of thing.
And URNM?
URNM tends to be a more concentrated bet. It focuses primarily on the pure mining companies and the developers, so that can lead to higher volatility, but also, potentially higher returns if the sector really takes off.
And that ETF structure is so important because you're instantly diversified. You're holding Cameco, you're holding developers like NextGen or Denison. It mitigates that single company risk.
Exactly. I mean, if one specific mine has a project delay or some political issue, and that happens all the time in mining, the impact is spread across the whole basket.
Okay, so Avenue 2 is the more concentrated route. Buying the individual mining stocks yourself.
This is for the investor with a really high conviction view. You're buying the foreign stocks of large producers or promising developers directly on exchanges in Canada, the US, or Australia.
So you get maximum direct exposure to the uranium price, but that leverage, it cuts both ways, right?
Oh, absolutely. You are taking on much higher company-specific execution risk. Will they actually hit their production targets? Can they control their costs? Plus, you assume much higher political risk, especially with a developer whose main asset might be in a, let's say, less stable jurisdiction.
Right.
You really have to be comfortable doing intense fundamental analysis for this route.
And just for completion, let's briefly touch on the other riskier options.
Sure. You can get partial indirect exposure through like a thematic or a clean energy fund,
Yeah.
but they aren't pure uranium bets. And then you have derivatives or CFDs from offshore brokers.
Which we should probably warn against.
Honestly, for most people, yes. The leverage, the counterparty risk, the regulatory risk, it's astronomically high for a retail investor. They're generally unsuitable and should probably be avoided.
So once an investor has picked their avenue, say an ETF, let's talk strategy. How should you think about portfolio construction? How big should this allocation be?
This needs discipline. The specialist commentary suggests a tiered approach based on your risk tolerance. The biggest slice, your stability base, that should be your core allocation.
So that's the established producers, the ETFs like URA or URNM.
That's right. Then, moving further out on the risk curve, you'd have a smaller allocation to the near-term developers. These are companies that are already financed, permitted, and are close to production.
Higher risk, but higher potential reward.
Exactly. And then, only for those with the highest risk appetite, a very small speculative sleeve could go to pure explorers. These are basically lottery tickets dependent on drilling success.
And we have to put this in context for the Indian investor. Given the complexity, the overseas nature of it, how should you size this in your portfolio?
This is crucial. This theme has to be treated as a high-risk satellite allocation.
Not a core holding.
Definitely not a core holding. It should be sized modestly within your overall portfolio. You're allocating to a sector that is completely dependent on global government policy and the stability of very distant supply chains.
Speaking of those risks, let's dig in. Beyond just the obvious uranium price volatility, which risks are the most acute right now?
The two biggest are policy and currency. Policy risk is like the sword of Damocles hanging over the whole sector.
Yeah.
A major reversal, say a new government somewhere decides to abandon nuclear entirely, that could just instantly reverse the whole demand story.
And the risk that hits an Indian investor directly, no matter how well the stocks do, is the exchange rate.
Absolutely. Since you're using LRS to remit US dollars, all your returns are measured in dollars, but your actual wealth is in rupees.
Okay.
So if the USD-INR exchange rate moves significantly against the dollar, well, even if your ETF is up 20%, your actual return in rupee terms could be way lower. It could even be negative. You're managing two volatile assets, the commodity and the currency.
Which demands periodic rebalancing.
It does, and we have to reiterate that geopolitical risk with the supply concentration, a major disruption in either Kazakhstan or Canada, whether it's political instability, floods, fires, sanctions, it directly impacts the entire global supply outlook, much more so than in other commodities.
So what does this all mean? The ultimate takeaway seems to be that this combination of decarbonization goals and extremely inelastic concentrated supply has created a really powerful long-term tailwind for uranium.
It has.
But accessing it successfully requires more than just being bullish. It means navigating overseas channels, applying a tiered strategy, and actively managing all these geopolitical and currency risks.
And if we connect this to the bigger picture, while the investment thesis itself is strong, that high concentration of global production in the hands of basically two major geopolitical actors, it means the biggest variable for your portfolio over the next decade won't be pure market dynamics.
What will it be?
It will be the geopolitical stability and the national policy decisions made in Astana and Ottawa. At the end of the day, you're betting that they maintain production and that those governments remain stable partners.
That is a profound and fascinating thought to end on. Remember, you aren't just betting on clean energy. You're betting on the stability of a few key supplier nations. Keep that concentration risk at the very forefront of your mind as you think about building out any high-risk satellite allocation here.